Hello, friends. Thank you for tuning in this week. We have a great episode. But before I introduce the guest, as always, please follow, subscribe, rate, and review the show. It helps boost the podcast and grow the audience and ultimately helps me create the best show for you guys. So please do that. Additionally, please follow me on social media, ROYBTZ on Instagram and ROY_BNTZ on Twitter. On Twitter, you can subscribe to the newsletter, which gives you access to updates, occasional blog posts, news about the guests, and future of the show. And most importantly, it's just a very easy way for you to get access to every single episode each and every week into your inbox. Go check that out. Finally, please consider supporting this independent podcast. As you know, currently I do not run any ads by any other companies. So if you choose to support this podcast, I would be very much appreciated. If you feel like you get value and if you love the podcast, please show it by supporting it. Finally, if you want to start your own podcast, I have a full tutorial that covers everything you need to know, A to Z, literally the whole kit and caboodle, executing marketing, reaching out to guests, everything you need to know about starting, creating, growing a podcast is on that. So if that's something you're interested, go check it out. It is in the show notes. All right, let's move on to the guest. This week I have Mark Achler. Mark is the managing director of Math Venture Partners. Additionally, he also teaches entrepreneurship at Northwestern University Kellogg School of Business. Mark has been around for a very long time. He has started 4 different companies. He was starting startups back in the 80s before it was cool and popular thing to do as it is today. He was also the senior vice president of new business strategy and innovation for Redbox. So to say that he's been around the block, it's an understatement. Mark has a ton of knowledge, and I'm glad that he could come on the podcast and sit with us for an hour and discuss it. Also recently released a book called Exit Right: How to Sell Your Startup, Maximize Your Return, and Build Your Legacy. I will link it in the show notes, make it easy for you to buy it. And let's jump right into the episode. Let me introduce this week's guest, Mark Achler. Enjoy the episode, everyone.
The Genuinely Interested Podcast.
Mark, thank you for coming on the podcast.
Hey, Roy, it's such a pleasure. I really appreciate the invitation.
Yeah, we got it done. We had a couple of setbacks, but I'm glad we got it done.
Yeah, thanks. It's I've been excited. I've been looking forward to this conversation.
Awesome. So maybe tell people a little bit about yourself who may not know who you are.
Yeah, so my name is Mark Achler, and I am the managing director of Math Venture Partners. We're an early stage venture capital fund based in Chicago. And I am a serial entrepreneur. So I've built 4 software companies from scratch. And before that, I started one of the very first computer retail stores in the country. And I worked at Apple Computer back in 1983, 84. I'm the OG of computing. So I was the worldwide introduction manager for the Apple IIc a long time ago. And then I started 4 different companies. I had a venture capital fund in the 90s during the dot-com era. We had 2 funds. First fund was a lot of fun. Second fund, not so much. But we can talk about that. And I also was part of the executive team that helped build out Redbox, the movie kiosks. I was the head of innovation and also the interim head of marketing for Redbox, and took that company, helped from startup to a couple billion in revenue. So that was a lot of fun. And now I teach. I'm a professor. I'm an adjunct professor at Kellogg at Northwestern University. And I also do a lot in the nonprofit world. That's really important to me, the giving back part of it. And, I just love to build communities and joyful innovation and teaching empathy. And that's sort of the organizing principles for my life.
So it sounds like you have a little bit of experience in this space. It seems like you know a thing or two.
Well, I have a lot of scar tissue.
What was it like starting a startup back in the 80s or 90s? Like right now you can put out a tweet and someone will send you like a, pro forma and you fill it out. Like you could have next day, you could have funding. I'm assuming in the 80s, 90s, it wasn't that easy. Not that I'm saying it's easy now, but like it's much more accessible and accessible, I guess.
Well, I started my first company in 1986 and we raised venture capital in 1987. So we built a product, got about $500,000 in revenue, went out and raised venture capital. And you got to remember in 1987, I don't know, maybe there were 20 VCs in the entire country.
Yeah.
Today there's, I don't know how many, 10,000 plus VCs.
Yeah.
Back then there were 20. And when I told my friends and family I was going to be an entrepreneur, they looked at me like I was from Mars. Back then, everybody went to work for IBM or a large company. Like they couldn't fathom that I would leave Apple and try to start my own thing.
It's kind of wild how fast that happened, right? Like let's say even you're talking about the 80s, but even the 90s and maybe even early 2000s. Like if you were to say, oh, I want to be internet entrepreneur or, start a company, a SaaS, or be even a creator on YouTube or Instagram, right? Like people would, I don't know if they would laugh at you, but they wouldn't take you seriously, at least, right? Or your parents would be like, no, that's not a trajectory for you. That's not an actual business model or a profession. Now it's a completely different story. And that's not a long time. That's 20 years.
Yeah, the world changed. I'm an adjunct professor at Kellogg. And 20 years ago, when we did surveys of the students, we said, what do you want to do when you graduate? They all wanted to be investment bankers, or they wanted to work as consultants for McKinsey or Bain, or Kellogg particularly had a good marketing school, so they wanted to work in large CPG companies. And less than 5% of the student population, the MBAs, wanted to be an entrepreneur. This is 20 years ago. Today, it's like 40% of the student population wants to be entrepreneurs. Yeah. It is completely shifted. And part of that is who are our heroes. 20 years ago, maybe Bill Gates and Steve Jobs were reaching the mainstream consciousness that, oh yeah, these are doing well. But today you've got Jeff Bezos and Mark Zuckerberg and Elon Musk, and it's become accepted that one of the ways to create generational wealth is through technology.
Yeah, and not even the big guys. Like even if you look at quote unquote smaller people, right? Like people who will make like $100 million exit, and I'm saying small with air quotes. You can't see the air quotes, but like in comparison to the 3 Comma Club, the billionaires, like the people, that's amazing. That's like you said, generational wealth, and those people should obviously be celebrated, and they are celebrated. But I think a lot of times maybe they don't talk about the tough road, the journey to get from idea to creating, to marketing, to building, to eventually, after many, many years, selling. Like they only, at least in the media, they'll only tell you the final part of it. Yay, they sold 100 million, 200 million, 500 million. And the whole story gets lost in the mix.
It is so hard. It is beyond hard. and you're absolutely right. You only see the headlines. Mm-hmm. One of my favorite quotes, according to the National Venture Capital Association, of all the companies who get venture capital funding, and know that most don't receive venture capital funding, but of the ones who do, 67% of the companies who receive venture capital funding return less than 100% of the capital they receive.
Wow.
60%, 67% fail.
Wow.
Now, let's put that in perspective. So in my venture fund, we probably see approximately 1,500 to 1,700 companies a year between the multiple partners. There's 3 partners in our fund. And we make approximately 10 investments a year. So we see, I'll call it 1,600 companies. We make 10 investments. So
how do you even choose? Like, is it, that's like, that, those are such small numbers.
Yeah, right. That's my point. And right. And I'll answer that question. But think about it this way: 1,600 to 10 of the 10, 67% fail, according to the National Venture Capital Association. Hopefully, our fund's a little bit better than that. But nonetheless.
So you have 3 to 4 successful companies out of those 10, statistically speaking.
Statistically speaking, right. So you see the headlines, the big splashy headlines. Oh, 100 million exit plus, welcome to the unicorn club. But the reality is, for the vast majority of companies, they don't succeed.
Yeah.
Right. And so it is hard, and the odds are against us. And I'm speaking as somebody who started 4 companies. My first company, I did okay. It was like a single. My second company failed miserably. My third company did well, and my fourth company did significantly better. But it took, I always like to joke, I put my wife through hell the first 10 years of our marriage.
Yeah.
Like, it is really a hard road.
Yeah. No, for sure. Why do you think the second one, I don't know what the product / service was, but why do you think the second company didn't do well?
Yeah, it was timing. So the first company I started was a development tools company. We built the second product ever for Windows 1.0. It was the very first object-oriented programming language on a PC. The second company that failed was an educational software company. When CD-ROMs first came out, my kids were little. I wanted to teach them how to read. There wasn't great tools out there. And we created some CD-ROM based educational software teaching kids how to read. And it was right before PC. My wife famously said, this is never going to work. And she was right. Yeah. And the reason was, by the end of the 1990s, many people had computers at home. And, we're starting to see the internet was starting to come, the .com. But in 1991, when we started it, personal computer penetration in the home was relatively modest. It was relatively small. And this is before Windows 95, before them, it was very early days. And just not that many people had computers at home at the time.
There's so many crazy articles that you read now, and obviously hindsight's 2020, but it's just like from like the 90s where they're like, the internet is a fad, or why would anyone ever want like personal computers in their homes? And like, Jesus Christ. And then like you start thinking like, what are those things of now? Like in modern times, the things that we're kind of overlooking as maybe a fad or something that's just like, oh, that's ridiculous. I can't take that seriously. And then, I don't know, 5-10 years from now, it'll be like the thing, right?
I know it's hard. Very few people have the ability to really, truly envision a future without the context of what is possible.
Yeah,
it's a real skill.
So your book that you have right now, Exit Right, How to Sell Your Startup, Maximize Your Return, and Build Your Legacy. It's interesting because I think a lot of entrepreneurs starting out, all they're thinking is about survival, right? They're not really thinking about, maybe some are, but for the most, it's just like, all right, I need to get to the next stage, to the next raise, sell the thing, customer service, build the product, functionality, UX, et cetera, et cetera. Selling your company, exiting seems like something in the distant future. But I guess and the interesting thing is, like, I've also heard investors say that if they're, and this isn't all investors, it's just a few investors that I've heard saying, like, if you're thinking about an exit strategy right away, I'm not going to invest in your business, which is weird. Yeah, go ahead. You want to?
Yeah, so there. I believe
there's like 50 questions in my thing, but yeah.
So Paul Graham put it out there that don't worry about the exits, just put your head down, build a great company, and eventually good things will happen. And we respectfully disagree, and I'll tell you why. So the first thing is, when you take somebody else's money, you're taking their agenda. And my agenda as a venture capitalist is really straightforward. I want to make X return over Y timeframe. Mm-hmm. Well, so if you're taking my money, that's what the reason I'm giving you, investing my money into you is that's my agenda. And so the minute you start taking other people's money, you're taking their point of view and perspective. And a lot of entrepreneurs think, especially in the heady days of the last couple of years, that the more money they raise, the better. Mm-hmm. The higher the valuation, the better. The more prestigious the venture fund, the better. And my answer is, well, maybe. And oftentimes not really. Because what really matters, what I tell entrepreneurs is when there is an exit, there's something called a waterfall distribution of proceeds. Okay. So, X amount of money is going to be distributed. Who gets what? There's sort of rules, preferences of how you determine the preferred shares, which class of share, common shares. And the only thing that matters in an exit to a founder is at the end, at the very end of a waterfall distribution, what are the common shares worth? And the more money you raise, the higher the bar, the bigger the preference stack. The higher the valuation, the greater the pressure for subsequent rounds. I can't tell you how many times especially now as valuations are starting to tighten up again. Mm-hmm. When you have a really high valuation and you think about it like a chess game, you're playing 2 or 3 steps out. It's now time for your next round or it's time for the exit. If that valuation is really high and your business hasn't really hit the inflection point yet, how will you be able to raise your next round, or will it be a down round, right? And, the quality of the prestige of the name matters for sure, absolutely. But what really matters is, do you have an investor, the individual investor, who you share values with, who will be in the trenches with you, who can really help you grow and scale your business, who's going to put in the time? Because it's going to take 7, 10, 12 years. Like, are you really going to want to be in the trenches with this person? And a lot of times, especially what we're seeing right now, is a lot of these larger funds, if you're not going to be the home run, let's say you're just going to be a double. It's going to be a good company. It's not going to be a great company. A lot of these larger funds, it's not worth their time anymore. They move on to the next one.
Yeah. So, go ahead.
Go ahead.
No, I was just going to say there's so much money being thrown at impressive entrepreneurs nowadays who build dreams, but not necessarily great companies, as far as profits are concerned, or even like a functioning product or service. And I can name a few like Theranos and Quibi and WeWork and Juicero. And now there's a company.
Yeah.
And they're all different. Like this, I'm not saying they're all the same, but there's definitely a trend. And it's marketing, right? Like now there was a company Fast, the fast checkout company. Again, I won't go into the numbers, but it's ridiculous that at the end of the day, like, our investors just as guilty for falling for these big energy, charismatic characters with potential some messiah complex that can promise these massive returns and have this great vision, but don't end up delivering, I guess.
Well, think about it this way.
Sure.
I think about it as a trader mentality or a builder mentality. Mm-hmm. If you're a trader, and that's TRADER, a trader. Yeah. Not traitor, right?
Yeah.
If you're a trader,
not treason.
Not treason. You're a trader. What you care about is momentum up or momentum down. Mm-hmm. And you really don't care about the underlying asset. And over the course of the last decade, with valuations only going up, it almost didn't matter what you bought in at as long as the next person down the line was going to pay more. And if you're a trader, then you're comfortable with that. Doesn't make you good or bad, right? I'm a builder. I love to build real companies with real products, with real revenue. I have a much longer term point of view and perspective, and I want to build and grow and scale. Mm-hmm. Now, traders can make a ton of money. Like you can, if you got in early and you sold before the markets crash, or if you time it well, you can make a boatload of money. And there's been a lot of people in the last 5-10 years who just really made it didn't matter what the valuations were because the next person down the road was going to pay more.
Yeah.
But that's not me. I'm a builder. I just want to build real companies with real value.
So what does a great exit look like? Other than obviously, a vault filled with cash, like what's a great exit strategy like?
Okay. Well, before I answer that question.
Sure.
All right, I'll answer that question and I'll wind it back a little bit and tell you the story of the book. Okay. So we came up with this framework we call FAIR, which is fit, alignment, integration, and rationale. As a decision-making framework to help evaluate a potential deal and how to maximize value. And we'll talk about each one of those things, what makes a good fit culturally, how do you build alignment with all the key stakeholders. Most companies, integration is an afterthought after a transaction happens. We happen to think that an integration plan before a transaction happens, we could talk about that. And most importantly, how do you build a great rationale? And a rationale so simple and compelling, your grandmother will understand it.
Yeah.
Right. And so what we did is we went out and we interviewed dozens of CEOs who went through transactions. And we asked them all sorts of questions. We said, okay, tell us the real story. Give us the wisdom, give us the scar tissue. And if one of your adult children was going to sell a business, what would you tell them? Like, what do you know today that you wish you knew before you sold your business? Mm-hmm. And we got all sorts of great stories from large companies and medium companies and small companies, phenomenal stories. But I'm a big believer in empathy. So we went and talked to all the stakeholders around a transaction. And we went and we talked to M&A attorneys and some of the best M&A mergers and acquisitions attorneys in the country. And we talked to bankers, investment bankers. And we talked to the heads of corp dev at so many of the big tech companies. And, we asked the heads of corp dev at all the big tech companies, we said, okay, give us an example of one of your best transactions and why. What made it such a good transaction? And give us an example of one of your worst transactions and why did it fall apart and why was it bad? And what do you wish CEOs knew before they came to talk to you? And going back to when do you start thinking about an exit? One of the things that we heard from the leaders at Corp Dev, every single one of them, was the most important thing is trust. And the way to establish trust is to come talk to us before you're ready for a transaction and to begin to build a relationship. So, and that, one of the things that we found out is that trust is the currency. When all transactions have their ups and downs, there's always a moment where the deal hangs on a pin that it's about to fall apart. And what gets deals through is the personal relationship and the trust between parties. And that trust takes time. It really takes time to build it and earn it. So that was part of the journey of how we put the book together.
You and your co-author, right? Merit Iseri?
Yep, yeah.
How did you two meet?
This is a great story. So I'm 64,
okay,
and Mert is 34.
You're 64?
I am. I'm 64.
You look 45. Okay.
Yeah, my joke is it's nice now, but when it really mattered when I was in high school, I looked like I was 10. But Mert started a company called Swipe Sense right out of college, right out of Northwestern. And we got introduced, and he pitched our venture fund, and we said no. We said, no, I'm not interested. But I liked Mert, and we became friends, and I started helping him. And my partner, Troy Hennekoff, we started coaching him and mentoring him. And a couple years go by, and he raised a little round, then he's raising his big round, and he comes and he pitches us, and we say no. But by now I've adopted him. I became a mentor and a friend. And then he came to us a third time, and we said no. But we became very close. And it was 10 years go by. It's time to sell his company. And he ended up selling it to SC Johnson. And it was a difficult transaction. It wasn't easy. SC Johnson was really good at buying CPG companies or warehouses, but they had never really bought a tech company before. And there's some nuance to a tech company sale. And the transaction had its ups and downs. And Mert would call me during the transaction, even though I was not on his board, I was not an investor, but I was his unofficial sort of mentor. Mm-hmm. And I'd walk him off the ceiling, and we would help him stay calm. And finally, the transaction happened. And a week after the transaction closed, I was having coffee with him. This is in March of 2020, right before COVID, a week before the lockdown. And Mert was not happy. He was not a happy camper. And I said to Mert, Mert, in the spirit of giving back, why don't you write it down while it's still fresh in your mind, so that the next time SC Johnson buys a tech company, you could go back to them and say, hey guys, this is what I went through. Here's some suggestions of how we could make it better. Cool. So out vomited 10 pages. And I looked at it and I realized, there's a book here. There's so many books out there, business books about how to start businesses, how to raise money, venture deals, the messy middle, sales, marketing, culture. There's no shortage of business books out there.
Yeah.
But there's very few books out there about how to sell a company. And when I thought about it, we realized, confidentiality, everybody signs a confidentiality agreement. The details, at least especially early on, are not public. If it was a good outcome, people don't want to brag. If it was a bad outcome, maybe they're a little embarrassed.
Yeah.
But there's very little out there. And so that's how I met Mert, and that's why we decided to write the book.
Wow. That's awesome. How did you find the process of actually writing the book?
Joyful and tortuous. The interviewing, the primary research. So okay. I started out the process. Look, I've gone through multiple transactions as a CEO. I've invested in math in my former venture fund. I've invested in over 100 companies. I've sat on dozens of boards. I've gone through lots of transactions. And I thought to myself, hopefully with a little humility and not too much hubris,
yeah.
Well, this will reinforce what I already know. And I couldn't have been further from the truth. I learned so much. The primary research we did in interviewing dozens of the CEOs and the bankers and the attorneys and the corp dev leaders, that was joyful. I had a blast just listening to all the stories and getting the wisdom and just pulling the threads of what, where we saw some patterns. That was really fun. Writing a book, I don't know about you. I've never written a book before. Like the discipline of forcing yourself to put that down on paper and then rewrite it and edit it and do it again. And that wasn't so much fun.
Yeah. I have written a book that I've never done anything with. It's just sitting on my computer, and I've given it a good amount of time, and I've edited it and re-edited it and re-edited it again, and a fourth and a fifth and a sixth and a seventh.
Right.
Yeah. It's a labor of love mixed with torture. That's a pretty accurate way to describe it. But
go ahead.
Oh, no, I was just going to say, like, to your point, like that's, when you were saying like talking to people and learning from them, that's kind of why I love doing this podcast. It's not like this is like some crazy money-making machine, right? Like, right. But I do love talking to people. Every episode, I'll get like a couple of nuggets that like I hold on to, and like, wow, I never thought about, or I never knew that, or whatever. So every episode for me essentially is kind of a learning opportunity, which is why I love doing it.
Yeah, I couldn't agree more. One of the things that I think makes a good entrepreneur and a good venture capitalist is always being curious, like being open-minded, always learning, just excited to talk to new people and learn new things. And this journey for me was that experience. I really enjoyed the process and the intellectual rigor of really honing a craft and building some deep intellectual thought around a specific topic. I never really went deep. I spent, this book took about 2 years, start to finish. And, 2 years focused on one topic, you really start to think deeply about it.
Yeah, no, for sure. And I think also, this is something I've learned is you need to listen more than you talk, and not think about what you're going to say when you're listening. So a lot of times, at least probably the first 50 episodes or so, I was trying to talk much more than I do now, right? A, and then B, I would be thinking about my next question instead of listening to the guest, because I was so nervous. I was like, all right, you can't have that lag. Now it's not that I'm far from perfect on both those issues, but I've become much better at both, like both on the listening side and both actually really like, embedding myself, or not embedding, like allowing myself to listen to the guest much more instead of thinking about what my next question is going to be. So I really, Yeah,
that's a skill. It's really hard to be an intentional listener, to really focus and listen to the other person. That takes practice.
Back in Israel, it's very common to hear people talk about exits. It's actually probably too common. That's all you hear about. Right. But that's all everyone is interested in. Here in the U.S., I mean, it's a different culture. You don't really hear about it as much, which is what you alluded to earlier. But I'm just wondering, like, culturally, why do you think that is?
Well, I think to me, it depends. Are you trying to optimize for the short term or the long term? If you're trying to create something of lasting value, you're not really focused on the exit. You're focused on your customers. You're focused on your employees. You're focused on your strategic partners. You're focused on building a business. And from an exit perspective, I'm from the Midwest. I'm from Chicago. We tend to be more humble in terms of, nobody wants to brag. Nobody wants to show off. We just want to create value. We're sort of a little bit quieter about it.
Yeah, but maybe in the Midwest, but on the coasts, there's a tendency to brag. It's not as humble.
Yeah.
It's not as humble.
Yeah, but I've lived through a lot of economic downturn. I've lived through 87 and 91 and the dot-com days and 07, 08, 08, 09. And, I just had shit kicked out of me over the years. So we wrote this book really to give back. I mean, our philosophy is we just wanted to help entrepreneurs.
That's awesome.
Yeah.
What would you say is, like, off the top of your head, like one company that's done an amazing exit where everyone included was happy, they did good, like the founders did good by the employees, everyone came out on top? Like, is there?
Oh, there's so many.
What are a couple? Yeah.
Well, actually, I'll give you one that's controversial on lots of different ways. When Facebook bought Instagram, and they bought them for $1 billion, everybody thought Mark Zuckerberg was crazy.
Yeah.
The Instagram team was happy, the investors were happy, and although not all the employees were happy, we could talk about that. Mm-hmm. But one of the things that we talk a lot about is how do you value an exit? And I'm going to use this as a great example. Most people, when you talk about exits, they look backwards. So looking backwards, it's a multiple of revenue, right? And so if it's a financial transaction, maybe it's a multiple of EBITDA. If it's a strategic transaction, maybe it's a multiple of top line revenue. But it's but a revenue number, a multiple of revenue, is what was done in the past. The way of creating value is to understand together that rationale of how 1 + 1 = 100, and how the company that's being acquired, how they plug if it's a strategic investment, how they plug a strategic hole to create additional value. So using that Facebook today, when Facebook bought Instagram, they had, I think, zero revenue or close to, I don't think they had, I think it was pre-revenue. Mm-hmm. Today, Instagram represents like $20 billion of revenue for Facebook, right?
Crazy.
It's crazy.
Yeah. Because
they understood that if you took that user base and plugged it into the Facebook sales engine, how they could monetize it.
Yeah.
I like to tell the story when my partner, Troy Hennekoff, this is back in 1991, he had a little software company and they created some billing software. It was the very early days. And they had Hyatt as a customer. And Medline, a big medical supply company, wanted to buy his company. And they offered him something, and Troy said no. And they offered him something, and Troy said no. He didn't want to sell. And then they offered him a number. They offered him, they were doing $1 million in revenue, and they offered him $5 million. And Troy went, "You guys are crazy. Why would you give me $5 million?" And he said, fine. Okay, fine. And he sold his company to Medline. Mm-hmm. What he didn't understand is that Medline used that billing software, and they went to their existing customer base and they said, today you have a 1-year contract with us. If you sign a 3-year contract, we'll give you this billing software for free. In the first year, they generated an incremental $100 million of revenue.
Wow.
Off of that billing software. Well, Troy thought he had a great deal, but what he didn't understand was the rationale of why Medline wanted to buy him. Yeah. Because what would $100 million of incremental revenue at the Medline multiple, what was that worth? Well, that could have been worth, $500 million.
Yeah.
but he didn't understand the value he was creating. And so I have a saying, I have these empathy rules, which is, it's not about you, do your homework, and bring a gift. And so what I mean by that is it's not about you. It's always about the person you're sitting across the table from.
Okay.
And when you have a chance, I talked earlier about getting to know the leaders of Corp Dev. One is to build trust, but the other is to gain knowledge. So every time you have an interaction with a potential strategic partner, strategic acquirer, it's an opportunity for you to ask questions as well. And and sometimes they'll be forthcoming, sometimes they won't, but it's an opportunity for you to understand what holes the larger acquiring company is trying to plug and the value. So I'll give you an example. If I'm making this up, if you had a company, if your product was acquired by a larger company and it made the retention numbers, if you improved retention, even by a small amount of the much larger company's core product, what's that worth? I mean, that's worth significantly more than 5x revenue, trailing revenue on your small little company. So trying to understand that is critically important.
Is that empathy though?
Well, it's knowledge. Yeah, empathy is understanding the other person. So here's an example.
Okay.
For enterprise salespeople, I say to them, who's your champion? And there's always somebody. I say, okay, when your champion gets a bonus at the end of the year, what is that bonus predicated upon? What are the KPIs? Right? What do they care about? And most enterprise salespeople can't answer that question. I don't know. I don't know what if you don't understand the KPIs of your customer, if you don't understand what they really care about, what metrics are important to them, where's the leverage, the financial leverage, how are you going to solve their problem? And in a sale, how are you going to know what's really, truly important to them?
Yeah, no, I could see that. I guess I know like it's 100%. I guess didn't see empathy as that. I guess it's like unique insights that you gain by learning a business or a sector or an industry. But it's interesting that you phrase it as empathy. It's like an interesting way to look at it.
Well, let me put it another way. If it's a publicly traded company,
sure.
All right, so here is a great thing that most entrepreneurs do not do.
Okay.
Right? If there's one thing you learn from this conversation, here's a great. If you're
take note, entrepreneurs, take note.
If you're trying to sell to a publicly traded company,
sure,
their quarterly earnings calls are public. You can listen into them, or you can read the transcripts. If I were trying to sell into a publicly traded company, I would go back and just listen to or read all the quarterly earnings calls and see what the company is reporting on and how they report. And more importantly, look at the analysts who cover that company and what questions are they asking, or what activists, investors, or shareholders, where are they pushing the company? Mm-hmm. Because you want to get the attention of a publicly traded company. Understand how they report, what they report, why they report, and solve that. And you're going to get, and by the way, nobody ever calls the analysts who cover publicly traded companies. They're kind of like the Maytag repairman. If you remember that commercial, like nobody ever calls the Maytag repairman. Yeah. If you call the analyst who covers a publicly traded company and you say to them, hey, tell me what you're like. What are you really paying attention to? And by the way, they're not doing this, or I've got a solution that solves this problem. Maybe that's something you should ask about. I guarantee you, if an analyst in a quarterly earnings call asks a question, that is pertinent to what you're doing,
Yeah.
the CFO is going to turn to the CEO is going to turn to the CFO, and they're going to go, that's a great question. We'll get back to you, next report.
Yeah.
And then the CFO is going to go, the CEO is going to go, get an answer.
Most of my listeners are entrepreneurs, but some obviously aren't. I guess why, maybe for them, right? Like why, or people that maybe aren't really into tech or maybe not as business savvy or maybe more into traditional business models. Why do startups even need an exit? Why can't they just run a company, make money just like a traditional business, right? Like a restaurant and just exist like that?
Well, look, if you don't have any shareholders and you own 100% of the equity, you can do whatever you want.
Mm-hmm.
And, one of the things when I teach a class at Northwestern and I talk to co-founders all the time, I just say, you guys have to be aligned on your values. If one co-founder wants to, or if one founder wants to build a lasting legacy that they're going to pass down to their children and their children's children, and if you have 100% control, then you can do whatever you want.
Mm-hmm.
You don't need to have an exit. If you have co-founders or other shareholders, and one co-founder wants to make as much money as fast as they can, and the other co-founder wants to create a legacy, that's an issue. If you raise money, well, investors need to get an exit because eventually they want their money back. And so the minute you take other people's money, then you are the clock starts ticking. And some investors have a much shorter time horizon. Some investors have a longer time horizon. But no matter what, eventually you're going to have to give them their money back. And typically the only way to give them their money back is either to take the company public, which very few companies can do, mm-hmm. or you got to sell it.
Yeah. Again, there's this like notion, and I think you touched upon this earlier, where the dream is to have the unicorn, right? Or to have a company with whatever, 100 employees that's raised $500 million. But for me, I'm like, if you're a company that's making whatever, right, $500 million a year or $1 billion a year, but you're also burning $1 billion a year, it's like, it would be better to start a 1 or 2 or 3 man company, bringing in 10 million a year, right? Keeping 8 million of those 10 or 7 or 6, whatever. There's just so like less overhead, less, anxiety. Just, it's a much better business model, but no one's not no one. A lot of people are doing that, but it's like they always focus on the big boys, the $1 billion companies, the unicorns, instead of these little guys that are making great money. And it's not little, it's millions of dollars.
All day long. If I had a company that was spitting out a few $1 million in profit, and I didn't have shareholders or investors, all day long. I think that's sign me up. I'm in.
But they don't get like the credit. They don't get the fanfare. They don't get like, the only reason you'll hear about them is because you'll listen to like personally, at least I'll listen to specific podcasts in business or startup. They talk about them like, oh wow, that's great. I can't believe they do that. But you'll never hear about them on like mainstream media. You'll only hear about the big, big companies.
Yeah. Look, the press likes larger than life stories.
Yeah.
So blood and guts sell. So you see all the horror, you see the horror.
If it bleeds, it leads.
If it bleeds, it leads, right? And same thing with the big numbers. Nobody's going to care about a small little 2 or 3 or $10 million company. They care about the big numbers. Mm-hmm. Those are the headlines that grab attention. But the reality is, if you could have a small business that you're happy with, that you don't require investors, and you can run it yourself, that's heaven.
Yeah.
Of course. And the problem with VCs, myself included, and I have this talk before I make an investment with entrepreneurs. I say, look, this is my business model. In our venture fund, we have small investments and larger investments. The larger investments, we have 15 slots. So if we invest in you, that's one of 15. It's really scarce. And so knowing that there is a higher failure rate, that means the ones that succeed have to succeed at a significantly higher value right? That's the business model. And so when we make an investment, a larger investment for us, the question that we ask each other, my partners and I, is, does this have the potential of returning the entire fund? Because if it doesn't have the potential of returning the entire fund, then we probably shouldn't make the investment. And you asked that question at the beginning, which I didn't have a chance to answer, which is, if we saw 1,600 companies in the year, but we only make 10 investments, how do we decide? Well, we decide, and we make mistakes all the time, but we try to determine which companies can get large enough where we could actually have a meaningful return, a 10x plus return, where one investment could return the fund.
What would you say if you had to break it down, team versus like the product or service? Like, what do you put more emphasis on?
Oh yes, so that's that's the famous, is it the jockey or is it the horse? That's sort of, at the end of the day, I always lean on team. It's just the greatest idea in the world poorly executed. Or we have a saying, our investment thesis at Math Venture Partners is, we invest in companies who have an unfair advantage in customer acquisition, who know how to sell. Mm-hmm. So I have a saying, which is, the greatest product in the world without customers is a great product. It's not a business, right? Yeah. And so the same thing here, to answer your question, is a plus team with a minus or B plus product, we'll figure it out.
Yeah.
The flip of that, not so much.
Yeah, no, I agree. Has someone who's done both, what's harder, raising capital or doing a successful exit?
Well, it's all hard.
It's levels of hard.
Yeah. An exit is an art form. Well, raising money is an art form. There's a really, it's skill, but there's a real art to raising capital. And the same thing, it's a craft about how to sell a business. And it turns out that there's some real important fundamentals about how to do it well. And it just takes lots of time and hopefully some wisdom, and you have an opportunity to get access to some of that information. Because every one of the founders that we talked to who are sold multiple businesses screw it up. Like they screw up the first or second business because it is just so emotional and so hard, and there's so much riding on it. Imagine putting your life for 10 years, you pour your heart and soul into a business, you put your life savings. My first business, we had, my partner stayed home and wrote the code. I went to work and I gave him half my salary. And my wife was out of her mind. And then when the product was ready, we didn't take a salary. And I put in, we didn't have much money, but I put in, we had like 27,000 in the bank, and I put in 25 of the 27 into the business. And and then I spent 9 years building that business. So when it was time to sell, everything was on the line.
Yeah.
It's just so incredibly pressure filled. And one mistake can just have a profound impact.
It's such a leap of faith. You have to not only believe in yourself, believe in your team, believe in the product or service. And then it comes with all the ebbs and flows of the anxiety and the depression. And this didn't succeed. This did succeed. Like the highs are high, the lows are low, and the middle just fades over time.
Well, and also I would tell you that you got to play the long game.
Yeah.
So it's not just a transaction, because what happens post-transaction? So one of the things I ask entrepreneurs is, will your employees come to work for you again? So most entrepreneurs, once they sell one company, typically they start a next company.
Sure.
Like, did you treat your employees well? Did you treat your customers well? Will your investors want to invest in you again? Did you treat your investors well? Did you look out after their interests? The acquiring company, a lot of transactions fail. Will the heads of corp dev want to buy your next company?
Yeah.
How important is your reputation? And a lot of people, like it's not a zero-sum game where I win, you lose. And how you take care of people and treat people are really, really important.
Yeah, no, I agree. Have you thought of starting, like, I'm thinking about this as we're speaking, which is going against what I said earlier, but have you thought about starting your own podcast where you interview, founders that have made successful exits? Because there are, like you said, with the books, there are plenty of podcasts about business and startups and strategy and marketing. I don't think there are many, maybe a few about exits and that aspect.
Yeah, there's a few, but there's not many. I had before COVID, I had a podcast series where I think I did about 8 episodes. I called it Profiles in Courage.
Okay.
And it wasn't about exits. It was just about courageous moments that all entrepreneurs have to go through. But when COVID hit, I like to do it in person. I know we're doing a podcast right now, but I like to be, I wanted to be in the room, and I kind of got out of the habit. But yeah, I could certainly that's certainly up there for consideration.
Yeah. I would listen to that. That's an awesome podcast.
Yeah.
All right. Before I let you go, what are, I guess, final question, like, what are some common mistakes? Because like I said, there's a lot of entrepreneurs and business people that listen to this podcast. What are some common mistakes you see first-time founders doing just over and over again? And something that you would just tell them, like, hey, I know this is common to do. Don't.
All right. A couple of things.
Sure.
One, have a long-term point of view. So so every day, I probably talk to 4 or 5 entrepreneurs who are pitching. And most entrepreneurs, myself included, when I was a young entrepreneur, I thought about it as a moment in time in a transaction. If that stupid VC wasn't going to give me money, and I moved on to the next VC.
Yeah.
But, I started the conversation with a story about Mert. Do you know what Mert, besides Mert and I being co-authors together, do you know what he's doing today?
No.
He became a full-time entrepreneur in residence at Math Venture Partners, my venture fund.
That's awesome.
So even though he pitched me 3 times, and 3 times I said no, we built a relationship, and we built a friendship, and we built trust, and we wrote a book together. And now he's a full-time employee of my venture fund.
Wow.
And so the reason I say that is it's so easy to just move past. And you're not going to do this for everybody.
Yeah.
But don't think in terms of relationships over time. Don't think about it's a transaction, and if they said no, then you're on to the next meeting. If you look for opportunities to build meaningful long-term relationships. And going back to my empathy rules, it's not about you. Do your homework. Really, nothing pisses me off more than when an entrepreneur walks into a meeting with me as a VC unprepared. Mm-hmm. They didn't read, they didn't go to our website. We actually wrote a 6-page document, a founder's checklist about how to prepare for a meeting with us. Because I've been, as an entrepreneur, I've pitched lots of VCs, and I wanted to educate entrepreneurs ahead of time. This is who we are. This is our investment thesis. This is our decision-making process. Like, the more you know. And so when an entrepreneur walks into a meeting and obviously didn't do their homework, that to me is a proxy. If they didn't prepare for a meeting with one of their most important meetings is with funding, they're not going to prepare for meetings with customers either.
Yeah.
Right. And then the last is bring a gift. And what I mean by that is add value to a conversation. There's always something that you can, because it's not about you, it's about the person sitting across the table. There's always something of value you could add about a piece of knowledge or insight or something about their website or some competitive information. There's always something that can add value. And if you can demonstrate that, I think that's really important.
Well, I heard you had a story about, I believe it's your friend's son that went to Groupon.
Right. Yeah.
I thought that was, I literally, after I heard it, I went and I told my wife the story. I was like, listen, this is a great strategy. It's a great way to look at it. Like, usually if you go into a company, you'll just, here's my resume, this is why you should hire me. And you just flip the whole thing. You're like, no, this is not how to do it. And it was just a great story.
All right. Well, I'll tell you the short version of this, but
sure.
If you go on YouTube, and I think the talk is empathy and persistence.
I can link it. I can link it in the show notes. Make it easy. Yeah.
Yeah. So the son of a good friend of mine, who was a couple years out of college, he was applying for a job at Groupon right in the beginning days when Groupon was just starting to take off. And he said, I've got this interview. Can you help me prepare for the interview? So I said, sure. Come on over and we'll talk about it. But before you come over, here's what I want you to do. I want you to go interview 10 local merchants and ask them all sorts of questions about Groupon. And then I gave him the questions to ask. And so then he came over and we talked it over, and he went for his interview. And the interviewer says the classic line, which is, tell me about yourself. And I think that's the biggest trick question, because the interviewer really doesn't care about you. They don't really want to know. What they're looking for is, I've got this job. Does the person have the right set of skills? Do they have the right experiences to do the job? And is it going to be a culture fit? Is it somebody's going to fit in? Do they share our values?
Yeah.
That's what when they say, tell me about yourself. And so this guy says, well, I am so excited. When I found out I was getting this interview, I told all my friends, and my friends were jealous because I'm a big fan of Groupon. We use it all the time. And I realized that I understand the end user really well because that's me. But I didn't understand the customer. So to prepare for this interview, I went out and I cold called 10 local merchants. And would you like to know what I found out? And the interviewer says, yeah, of course. And so he went on and he says, well, a third of the merchants I talked to, they loved the product. They couldn't be happier. It generated all sorts of new business. It was really cost effective. Excellent. And about a third hated it. And I hated it. Why? And I found out that there's a real art to the offer. And if the offer was too good, too many people came, and they were the wrong type of people, and they were not repeat customers, and the merchant was losing money because the offer was too good. And so they really had a focus on They're finding that right, crafting that right offer. And about a third of the people had never heard of Groupon. It was the beginning days. And so I was talking to this one merchant. I told him all about you. And guess what? Here's an order. And he was the first salesperson to walk into an interview with an order already in hand. And he got the job instantly.
Of course he would.
Of course. Right? Because most people, when you say, tell me about yourself, they go, well, I did this, I did this, I did this. Right? And what he did is he didn't make it about himself. He made it about the company. Mm-hmm. And what he did is he demonstrated his work ethic and he demonstrated his understanding of the customer. And he actually brought in a sale to an interview.
Before he was even hired.
That's
awesome. I love that.
Yeah.
Well, that's a great story to end the podcast on. Mark, thank you so much for doing the podcast today. This was a lot of fun.
Hey, Roy, this was a blast. Anytime.
Yeah, man. So we talked before we were recording, but you're not on social media. But where can people find you and where can they find the book?
Well, thank you for asking. I am on LinkedIn.
Okay.
And so the name is Mark Achler, Achler. Just, search for me on LinkedIn. And it's on Amazon. So just all you have to do is exit Right Book on Amazon. Easy peasy.
Yeah. And I'll put it in the show notes as always, make it easy for you to just find, click, and buy. There's you should definitely do that as well. You should definitely go buy the book. Mark, thank you so much. This was a blast. Thanks for coming on the podcast today.
All right, Roy. It's an honor. Thank you.
Take care.